Got one person. Guys, welcome to our third night. I wanted to mention I'd posted a note there. Ryan had gone in and tried to clear out all the old IDs and reset everyone so that they could get in. If you're still having problems getting in, the suggestion that Ryan gave me was to go into your Internet Explorer and clean out your cookies, the temporary files, the history, and the forms, and then restart the machine, and that'll clear out the browsing memory. If you've previously signed, it will hold a space for you, and that could be what's causing you problems for the login. Got one person having an echo. Anybody else hearing me? Mr. Blaine, OU recorder, are you getting what we want to hear? Okay. Some people might still be logging in. We are going to move through towards go through our review. They can catch up when they get here. Now, most of you could probably have this memorized and could repeat it for me. I'm not going to force you to do that, but there we go. Our government disclaimer. And the second basis being we want to make sure that everybody understands that this is for education purposes only. We don't want you going out and trading on any of the information, suggestions, examples that I would give tonight during our class. So let me head to our review. Again, these reviews are going to be more or less just flashing slides. If you've got something you have a question on from last night, I did not get any emails from anyone last night regarding a specific. Well, actually, that's not true. I did get one, and I addressed it coming up in a slide a little bit later. But I didn't have anything pressing that needed to get taken care of. So again, with reference to calls and puts and the world currency options, if you're long a call, you have a right to buy that currency pair. Shorting the call means you have the obligation to sell that pair at a specified price, specified amount of money, at a specific time in the future. My email is actually over here on the bottom of the notes section, gmcdermott@optionsuniversity.com. Here's the graph of what a what a call looks like. I apologize for that cough, guys. Allergies are kicking up here in northeastern United States. Long call, you have a limited downside, unlimited upside potential. Short call, the opposite. Limited upside, unlimited downside potential. Long puts in the world currency options have the right to sell a currency pair. Short puts have the obligation to buy that currency pair. We just want to make clear that because it sometimes gets lost in translation, but with a currency pair, in effect, when you sell a currency pair, you're actually selling the base currency and buying the counter. So it is a two-part, and we've made that clear over the last couple of classes. Just want to remind everybody of that. The long put looks familiar to most. Make money below the strike down to zero. Theoretically unlimited upside potential, but it's limited to zero, and your downside is limited because you own an option. Shorting it takes you the other way. Your upside potential is capped at the premium you take in. Your downside can go all the way to zero. The world currency pairs, the British pound, the euro, Canadian dollar, Australian dollar, Swiss franc, and the Japanese yen. All of these currency pairs are based in what we would call the foreign currency, all have US dollar counter currencies. Keep them consistent. As we said, right size for the retail investor, we got the contract point value. 100 basis points is $100. Two options contract priced at $2.50. Cost the investor $500 in premium. The option contract price movement of 3 cents would be equal to a $3 dollar move, whether it would be for you or against you. Go to our next slide. Roll through these. European exercise for all of our world currency options, which means you cannot exercise them until expiration, which is the Saturday following the third Friday of the month. There it is, Saturday following the third Friday of the month. Settlement value for the underlying is at noon based on the Fed, and it's importantly a dollar cash settled option. Trading hours, what we would consider normal U.S. trading hours, 9:30 to 4. Position limits 200,000 on the same side of the market. Big positive. All trades issued and guaranteed by the OCC, the Options Clearing Corporation. World currency futures traded as the underlying to the world currency options. They're a perfect matched hedge. They could also be a standalone trading instrument. Here are your trading hours, open a little earlier, close a little later, same expiration cycle, same settlement value. They are also cash settled. That'll come into play later when we talk about this, and these are also OCC guaranteed. In summary, right size for the retail investor, our world currency options, allows you to trade in a volatile market with the advantages of options. Open traditional U.S. market hours, trades like an index option, and the equity option strategies and math work that you're familiar with on the PHLX world currency options. And we're not going to go through, I'm just getting everybody. Milton, you may want to check on your side because it appears everybody else has got a good connection. I hate to steal a joke from Ron, but this one we're probably going to have to blame on Al Gore and the internet. Fundamental analysis, what is it? It's the study of macroeconomic factors and their effect on the value of a currency. They can be economic, social, political. Again, we're just kind of refreshing your memory to let you know where we left off last night. The cross trade did bring up some issues last night, and we are going to go through these, and I've got some more graphics to help us with future values. I know there were some people who had some issues and wanted to make sure that we were clear on all of that stuff. Hey, Dave, that's pretty good. Let me see if you're right. I put down that probably is it. He's hearing himself, and that's causing the echo. Maybe that is it. I hope it is. So it's a nice, easy fix for everyone. The cross rate is a currency pair that does not include the U.S. dollar. I'm going to give you the examples of active cross trades: Euro British Pound, Euro Japanese Yen, British Pound Swiss Franc, Australian Dollar Japanese Yen. And what I want to show you is these are just examples. I'm going to shift over to my screen. I've got teed up the list of, I think it's here. Got a list of the futures, CME, foreign exchange. Let's see if this comes up. I'm going to just give everybody a look, just so you don't think that the world is limited. It would be for trading options as a cross trade, but if you found yourself in a part of the world where you had a local currency that you felt comfortable with, you may want to get involved with trading the futures version. I'm just going to give you a quick look at this. Is the list. Just pop this. This is from the CME. If you want to go there, www.cme.com, you can poke around, and just to give you an idea of what are the crosses that are available, I mean, there are as many as you could think of. And you see they've got them all listed as cross rates. I mean, we've got the euro versus the Polish zloty, probably mispronouncing that. Euro versus Czech. We've got anything you can imagine. So, again, it's not just listed. This is purely for an example. I just wanted to let you guys know that there are other crosses out there that you can trade. Again, you'd have to go trade futures. You'd have to open a futures contract. But, I'm not one that's going to tell you that the only way you should ever trade foreign currencies is to trade the world currency options. It should be part of your trading strategy. There's going to be times where trading the spot is going to be the better play. There's going to be times where maybe trading the futures is a better play, but we're going to, for teaching purposes, stick to the world currency options. But I just wanted to give you a look at the other ones that are available. I don't think. Let's see, this is delayed data, but this just gives you the foreign currency exchange products that they have listed down this left side. So, just an example. If you want to go check out the rest of the world, that's where the CME trades the large majority of the futures that are traded. Back to the world currency options. We did this examples of the active trades. Cross rates with affiliate options. It's the ability to create a synthetic cross rate option, buy a call and a put in different currencies, buy the XDN call and the XDC put in ratio. The U.S. dollars cancels out, and you end up with a yen Canadian dollar cross position. Here's the math. Again, I'm just going to let you guys, if you want to take a look, what you're doing is the basis is you want to create a ratio to set up the trade and try to make the U.S. dollars match so that you're similarly risked on either side of the market. Interest rates. Exchange rate of a currency pair is influenced by the interest rate differential between two currencies. It's influenced in the spot market, and as we talked about, it's also influenced in future dealings, whether it's a futures rate or a forward rate. And again, we talked about the market participants looking to buy or sell, low interest rates, the yen carry trade, which we talked about last night. Forward rates, one more time. I'm just going to put these up here. It's a dealer market, not a standardized market. Exchanged any two currencies, any amount. Agreed upon date beyond spot, which is plus 2 days. And the forward rate is used to equalize the interest rate differential between the two. I think it's time for me to get a drink of water so that I can clear my voice. Thanks, guys. I was just talking to myself. Here's the calculation for future value of a currency, found at a website called thismatters.com. Gives the things that you need to calculate the value, and here is the actual calculation. I came up with an example using the formula below. Pound dollar spot 1.8600. U.S. interest rate is 2%. Great Britain, the interest rate's 5%. 1 year forward exchange rate would be, and there's the math, 1.86 times 1 plus 0.0500 divided by 1 plus 0.0200, which equals, and the math is there, gives us an answer of 1.9147. For those of you that are real math fans, you will notice that right here in the formula, the number 1 plus the interest rate is raised to the number of compounding periods. In order not to mess it up, honestly, I made sure that my compounding period was 1 year to keep the math pretty easy. So for those that asked how it's calculated, I'm going to leave this up for a minute, let everybody take a look. This is what I found when I got to get to the actual numbers, so you can see. And you could change the spot, you could change the interest rates, and you could change the periods using these this formula, and it would give it to you. Yes, these are all going to be part of, well, the presentation will be part of the secure viewer. If Blaine is listening, do we need to make the slides available too? No, this formula will just be part of the presentation. Cam, if you want it, you can just send me an email. I'll be happy to send it to you. Anybody else who would want it, I'd be happy to send you that. I have a couple of cutouts, and I can even give you a link to the web page where it was, where I found it, so I can put the actual math. In fact, if you guys will indulge me for 1 second, I'll try to go grab, I'll cut and paste the actual web page for you and give it to you right now. Hang on 1 second. There you go, guys, and I'll try to post it right here below my email address. Again, I just was searching on the web to get the actual this website seemed to have the clearest explanation of how to go through the math. I also had a question last night. Someone took the time, and I appreciate it, to email me directly to ask me about how do you finding the at-the-monies in currency trading when you get beyond the front month because of the future values. Well, what I want to do is I'm going to show you. I have to click this one more time. There it is. We talked about when the base interest rate is higher than the counter rate. For example, the British pound versus the US dollar. The future value trades at a discount to the spot. And you can see this. This, again, is from the CME site today, just after the close. Here are the September futures, the December, the March, the June. Again, we're into 09, September, and December. And the settlement price is over here. 1.8579 for September, going down 1.8461, 1.8346, 1.8249, 1.8161, and 1.8073. George, you should be able to actually just click on that link because it's a hot link, and it should pop open a window for you and take you right there. If not, send me an email. I'll be happy to send it to you. But this is just, again, illustrating that. Yeah, I use the Phillips website a lot. I just wanted to pull these futures prices because I knew the CME would have the actual futures and they would have the best quotes. Now, the opposite is also true. With a base rate lower than the counter, the future value trades at a premium. Japanese yen versus the US dollar. And here we go. Same set of months. You've got 0.009119, 9170, 9227, 9284, 9343, and 9402. Again, illustrating our point that when these trade, okay, Kim, no problem. So this is, Philex is the one I do go to the most, and the CME. But this is illustrating, again, we talked about it last night, and I think I lost a couple of people showing them that. What I'm going to do now is I'm going to jump over to Thinkorswim, and I'm going to share my computer screen in 1 second. And I'm guessing that's the biggest pint of Guinness any of you have ever seen. Yeah, I agree completely, George. Why is this open twice? Please. Good. It is still there. Okay, here's what I want to show you. Someone asked me last night, let me do the quotes, and we'll put up the same two. XDB, British pound. Someone said, well, how do you find the at-the-monies? And we were searching through that. I've now got up on Thinkorswim, I have extrinsic value and delta as my columns. And let's go to November. what you're looking for is, sorry, this is the wrong one. I want to just do the yen, XDN. And here we go. I'm going to bring up all the symbols so we can take a look. And we'll even go to December so we can try to make it as exaggerated as possible. Note that currently the spot 91.01. That was the closing price on the PhilX World Currency Futures. So some would say, okay, well, 91.01, close this down again, this would be the at-the-money strike, the 91 strike. But if you look at the calls, the delta is 56, and it's almost all extrinsic value. So what we do is we want to look down towards another line. So you're probably, the future value on this is probably about, and again, I'm guesstimating down here somewhere between 91.5 and 92. Now remember, with the yen, it's a million is the underlying, so there's lots of zeros before these numbers, but these are the strikes. So to find the at-the-money option, you're probably closer, somewhere between the real at-the-money is somewhere about here. If you took this out farther and say you went to June, I think you probably find the 50 deltas right up here. Again, at the 93 strike, with the underlying currently at 91. So there's an example of how you would go about trying to find the at-the-monies, taking a look at the deltas that are available. You could also put intrinsic value, or you could put the intrinsic value up, use that. So just a look. I wanted to show everybody I don't want to share my documents. Cancel this. Documents. We'll go back to this a little bit later. Yeah, 50 delta at the money. Even though it's away from the current spot price, but as we've shown here, the current spot price is going to be different because of the effect of interest. We're just going to go through what we talked about. The carry trade. It's the simultaneous selling and buying of two currencies that have substantially different interest rates, converting the low-cost currency to high-cost, high-yielding currency, and investing those funds. I called it the hedge fund builder. It was the cornerstone of a lot of hedge funds that popped up over the last number of years. Onward and upward. Anybody have any questions before we go? I'm going to give everybody a minute here to take a breath. Let's see if we've got any questions. Okay, we'll take that as a no. I'm going to go over, as we get ready to start putting trading concepts together, I'm going to try to complete the groundwork for putting a trade on. What are the ways you kind of help to find, analyze, get in and get out of trades? Technical analysis. We are having a technical analysis class specifically on Tuesday. I'm sure everybody's going to be happy to know that although Wayne and Ryan are our two certified market technicians, they, by their own admission, do not spend their days analyzing FX charts. Our new instructor, who's going to be our spot FX instructor, is a proficient technical analyst who spends his days working with foreign currencies. We've switched the schedule around, and Sunil will be joining us for the technical analysis class. He will take care of that, and he will also, at the end, in our 9th class, go spend the time with us to talk about timing, when to trade the market. So he's preparing a specific technical analysis class. I've given him these slides that we're going to go over, so he'll know the general groundwork that we've laid about technical analysis, but he will speak specifically to how do I use these techniques? How do I use a moving average? What does he use with support and resistance? Does he use Bollinger Bands? Does he use Fibonacci? those sort of things. So tonight we're going to take a quick look at what you find, what are some of the tools that are out there, just give you a brief overview. This is not an all-encompassing technical analysis class where, to do a real all-encompassing one, you probably have to spend the 12 weeks with Wayne and Ryan. I'm going to give you a little bit of background, and that'll help move us towards trading styles and start with our long-term, with our short-term, and move towards long-term and gamma trading as we move towards Monday. So again, this is a look at technical analysis from a more of a definition. Some of you, I can't assume everyone here is a chart technician, so I'm going to make sure that everyone at least has a working knowledge as we go towards our class on Tuesday, that when Sunil mentions a candlestick or a moving average or a Bollinger Band, you'll have at least seen it once before and have some sort of reference point, so that doesn't become a waste of time for everyone. What is technical analysis? The forecasting of future price movements based upon historical prices. Try to identify trends and recognize pricing patterns. People ask me this a lot, Greg, why use technical analysis? Technical analysis can provide clear trading signals for traders. Another reason, and I've had this debate with people, I'm not a certified market technician when it comes to charts like Wayne and Ryan, and I don't have the proficiency in it that Sunil does. But sometimes, that doesn't mean I can't read a chart, but there are times when charts can become a self-fulfilling prophecy. Everyone's doing it. It can affect price movement, whether it's in the futures market, equity market, the FX market. People are looking at charts. Specific points are identified. And how many times have you been privy to information from someone like John Person or David Elliott, and they'll point to a chart and show you a 50-day moving average or a 200-day moving average, and the way stocks will hit those support levels or those resistance levels and reverse, it's not accidental. And some of it is because everyone is out there looking at the same number, and they all believe this number is the support number. If everyone believes it, it can become a self-fulfilling prophecy and can happen. Normally, if a stock or an underlying wants to move through that, it's going to eventually, but everyone believes that the support is 100, then you can bet that you're probably going to get a lot of people bidding 100 for the stock to try to keep it at what they believe is support. So that's one way to look at it. Now more than ever, I know David has spoken about it, that he used to literally have to chart the charts, and that's back when I was on the floor, the guys who were the chart guys would literally be getting their chart books, and they would be charting the numbers. They didn't get to just click like we do now and go to Thinkorswim and bang, 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 got all the charts you want, got all the charts you need. Technical analysis about equal to stock and options as far as these. Well, I'm not sure of your question, George. There are people who believe that the technical analysis for FX is actually a much better predictor than with stocks. I'm not going to argue that. It's a question Sunil could probably answer for you very well on Tuesday night. But again, there's availability now for everyone. You can get your free Thinkorswim paper account, and not only do you have access to their charts, but you also can, through their link, go to the profit and see if you can use their advanced charting package. And the currency price movements are geared towards technical analysis. And what do I mean by that is that you've got normally long trending moves, and they have a tendency to follow support resistance lines. Normally, again, there's always exceptions, but these, because of the length of the moves, it lends itself more towards technical analysis. Tools we're going to go over tonight so that each of you can put in your bag of tricks, that at least you have an idea of what these are. Moving averages, support and resistance, stochastics, the old RSI, Bollinger Bands, and Fibonacci's. And I'm pretty sure, having spoken to Sunil, that a lot of the things that he does are based on Fibonacci and Fibonacci retracements. I know David Elliott is a big fan of the Fibonacci retracements, and I'm positive Sunil will be speaking about that on Tuesday. And pivot points. I want to make clear we are looking at these as just a way to introduce the concepts. Candlesticks graphically describe 4 price points for each candlestick or time frame. Show you the opening price, closing price, the high, and the low of a specific period. So a lot of information given to you in one bar. It's not just a number. It's a graphic representation of the movement within that time period, whether it be a 5-minute chart or a 1-day chart or a monthly or a weekly chart. These all remain the same. It's opening, close, high, and low. Here's a look graphically on Thinkorswim. You notice they also use a color representation. The green bars, it's the way I have mine set up, are open. Those are movements where the close was above the open. The red bars, the close down here was below the open. So you can quickly, just red and green, if that's your layout, you can change the colors to anything you like, charting package, but gives you a quick representation of where have the price movements been over this specific period. This is a daily chart. Here's a zoom in a little bit more on that same chart, and you get a look at, for example, here, this is showing you the high point. This is showing you the low point. This was your open, and this was your close. The filled-in part is the distance between the open and the close. I'm sure there are some of you out there who are saying, hey, Greg, I see a hammer or I see a shooting star. And I'll be honest with you, I don't look for candlestick chart patterns in and of themselves. I look at the information available to you based upon the price movements that we see inside of here. A smooth line connecting points on a chart calculated by simple averages. The simple average, the price for a specific period. What are the ones we see? 200-day moving average, a 50-day moving average, a 10-day moving average. You can customize in Thinkorswim and most other ones any moving average that you find significant. No volume, George, are you talking about my voice or the volume in the underlying? These moving averages are normally seen as points of support or resistance. I mentioned earlier, you'll hear someone talk about technical analysis will use volume as one of the indicators. We're probably not going to go over that tonight, but that is, again, I'm not trying to give you an all-encompassing look at technical analysis. I just want to make sure you have a working, talking knowledge of some of the main points that will be brought up later so that you can get into trading using some of these. The points of support and resistance are often referred to. In fact, I know David Elliott, for those of you that have seen him, will often talk about, approaching, it's bounced off the 200-day, it's bouncing off the 50-day. Those numbers come into play over and over again. Here's a look at a simple moving average on a chart. This is drawn in as the 50-day moving average. You can overlay, and I'll show you at the end of this section of the class, you can overlay any number of moving averages, one on top of the other, if you so desire. I just use this as a quick graphic representation. And you'll also notice this is not a candlestick. This is technically a bar chart. It's not filled in, even though they are red and green and show high, low, open, and close. They aren't filled in like a candlestick. Resistance, a central concept in technical analysis. It helps you identify price points or price levels. Support's defined as the level that a price should tend to stay above. No surprise that resistance, levels that prices should tend to stay below. Will they always stay below? No. Do they always work? No. But in general, that's the concept. Here we've got a chart where drew very, very, very simple from this high up here going forward. That would be considered a resistance level. You can see a horizontal line drawn from this low all the way over to here did provide, maybe just not quite, but did provide some support here. It also, within reasons, provided some here. We're looking at a chart here of the British pound US dollar a little while ago. I'm not exactly sure when. Back in, I guess it was May. So this low level traded off this low, came up, in effect had some support. Now, for those of you that are proficient with charting, you might be able to have drawn, you might have drawn a line from here, and again, I'm not going to draw on this because I'll end up losing my chart, my package if I do, but you could draw a resistance line from here on this angle and connect these down here, and that would have shown you that once this broke across, that it probably has broken resistance, and then now this could be a support line. So again, this is a very basic overview, so you have kind of a concept of what are the things that the market technicians are looking at to try to come up with an idea of where the underlying, whether it be stocks, futures, currencies, where they are going to be going. Just don't want anybody coming into the class on Tuesday and not having these sort of tools at their disposal. Yeah, Bob, I mentioned that. I normally, on mine, I use bar charts. I don't use the candlesticks. I just mentioned that these are just, they're similar. They look similar, except they're not, the bodies are not filled in. They're still red. They're still green. They still show the open, the open, the close, the high, and the low. It just, graphically, I find it a little easier to look at these than candlesticks. And I'll show you at the end of this what my normal chart looks like when I'm taking a look at it. Stochastics, don't have to write this down, but the concept of stochastics developed by George Lane in the late 50s. The oscillator is a momentum indicator that shows the location of current close relative to the high-low range over a set period. Closing levels are consistently near the top of the range, indicate accumulation or buying pressure. Those near the bottom of the range indicate distribution or selling pressure. Elizabeth, do you mean... I'm not sure what you mean, Elizabeth. The technical momentum, just stochastic, a technical momentum indicator that compares the security's closing price over a given range over a given period of time. So where does today's close? Let me see if I can give. Got a raised hand. Bob's not getting any sound. Elizabeth, you have a microphone if you want to take a shot at this. I'll give us one shot today. I'll even turn my mic off for a second. If it works, great. I'm going to take that as we weren't able to get any sound for you, Elizabeth. I apologize. If you could just type in what you want to say, I'd be happy to get it out there for the class to see. Now I'm confused, so I'm going to move on. That's one of the mysteries. Seems like only Tom's the only one that seems to be able to use his microphone. Here's an indicator of a stochastic. Again, it's not a predictive indicator. It's showing you what has happened in the past. It's stochastic across this bottom line, showing the crossing of two different momentum patterns. I'm not here to give you complete detail. I'm just trying to get these concepts, these phrases, these names out in front of you. If you want to look some more of this up, I'm just trying to make sure everyone has a feel for what these concepts are before we get to them in the TA class. RSI, developed by J. Wells Wilder, introduced in his 78 book, New Concepts of Technical Trading. The RSI is an extremely useful, popular momentum indicator. Again, another momentum indicator. Okay, the bars don't show all that's going on the day, week, month, etc. Yeah, I mean, it's a personal preference. I like using them. I know people who love candlesticks. I occasionally flip over to candlesticks and kind of feel like if I'm maybe missing something, I do that. RSI compares magnitude of a stock's recent gains to the magnitude of its recent losses and turns that information into a range, 1 to 100. It's a single parameter, number of time periods in the calculation in his book. Wilder recommended 14. Yeah, Paul, that's the same. I mean, it's kind of the same reason why you go get ice cream. They have all those good flavors. Everybody kind of has their personal preference. And that's a real good point that both of you are making. When you're learning in this class or any other class, there is no absolute. There is no always, always, always. So you have to find out what works for you. You may be someone that says, I can't imagine, putting a trade on and taking it off an hour later. It's not my style. Well, then don't do that. Find what works for you. Find the concepts that work. That's when we had our Options Super Conference in Fort Lauderdale. I mean, we had, you don't get to use this word a lot, we had a myriad of speakers. We had a large number of speakers, and I'm sure a lot of you that were there or have seen the recordings heard some of them speak for 5 minutes and you completely tuned them out. And you had other ones where you were hanging on their every word. Some people connect differently, and so you really, the education process is as much trying to find out what works for you based on what other people are telling you. Yes, it does, George. Here's an example of an RSI indicator at the bottom here. In general, this lower bar, something below there indicates or can indicate a condition that is reaching oversold, and you could maybe look for a movement back over this line in general. Again, please, guys, know that there are no absolutes. This is just one more piece of information. Over here could indicate an overbought condition, and you might see a price reversal. You can see an example here where it crossed over. Corresponding high was reached. The rest is traded in kind of a tight range for this example. The Bollinger Bands. Bollinger Bands, technical analysis tool invented by Mr. Bollinger in the late 80s, have evolved from a concept of trading bands. Bollinger can be used to measure highness and lowness of a relative price. It consists of middle band. This is for your math guys. Middle band being end period, simple moving average. Upper band, K times end period, standard deviation. Lower, K times end period, standard deviation. The math can drive some people crazy. Typical values you get would be 2 standard deviations and a 20-day moving average. Moving average is trailing. It's not centered. This is one that you find a lot of people like to use. I know any of you who are familiar with David Elliott has heard the old phrase, the MOBO bands. And what David has done, and he has found in his trading, that he's taken Mr. Bollinger's ideas and tightened them up a little bit. And so he has this upper band and this lower band at a much closer standard deviation than 2. It's anybody who was down in Fort Lauderdale will know, because I probably helped you put it into your machine. It's 0.8 standard deviations. And what David is trying to do is he's trying to say, his concept is that when stocks are trading within that tight standard deviation range, it's just the normal noise of the market. When it gets outside of that normal range, that's when he takes interest in it and looks to see a price movement, a continuation of a movement. So it's one of the things that he looks at, and it's one of the things I like to look at as well. Fibonacci retracements. I'm going to keep reading. Term used in technical analysis refers to the likelihood of a financial asset's price will retrace large portions of an original move and find support or resistance at any key Fibonacci level before it. Continues in the original direction. Sorry to read these fast. I don't want to waste too much time boring you with the definitions. These levels are created by drawing a trend line between 2 extreme points, then dividing the vertical distance by key Fibonacci ratios, 23.6, 38.2, 50, 61.8, and 100. Brought to you by our friends at Investopedia. Again, David Elliott likes to say that the whole world is Fibonacci. The people that we would all, or that you may think in your eyes is an attractive male or female, David would argue that the proportion of their face or their body is in a Fibonacci ratio. And if you look at a painting that's masterfully done, the images and the shapes would fall into a Fibonacci ratio. I don't know if I necessarily agree with that, but it is an opinion held by a lot of people, so I'm just putting it out there. Here we go. I'm going to take a look at what a Fibonacci looks like. And again, you're taking your high and your low, and it drops in for you those predetermined 23.8, 23.6, 38.2, 50, 61.08. There's, I think that one's 78 up there, and then 100. So, and there are times, people after the fact will point and say, chartists will say, well, look, right there, it bounced off the 23.6 Fibonacci level. And, geez, it was 100% retracement here, and then, came off of that level. So another tool for you to use as you become more aware of the trading style that I think works for you. Pivot points, and I've highlighted the big difference. Pivot point is used as a predictive indicator. If the following day's market price falls below the pivot point, it may be used as a new resistance level. Conversely, the market price rises above the pivot point, it may act as a new support level. Again, from Investopedia, John Person, who we've at OU have been talking to for a while. He's been at a lot of our events. He's renowned for his pivot point analysis. It probably would be worth any of your time to go to his website, search him out, some of the work that he does with pivot points. And the biggest reason I think pivot points make sense as one of the tools in your belt is because of this. It's a predictive indicator. It tells you where prices are going to go. The rest of these that we've talked about are really telling us where have they been, so where do we think they may go. Some of them are indicators that are telling you the same sort of thing, and that's what we're going to get to next. Use more than one input when initiating a trade. Be sure, this is what I was just saying, your technical studies are non-correlated. If you use momentum, 3 or 4 or 5 momentum indicators, if you use those 3 or 4 or 5 momentum indicators, they're all going to be telling you the same thing. It's like when if you ask all of your friends, and you've known each other for a very long time, for their opinion, should I do this or not? Odds are, if they've all known you about the same amount of time, you're all pretty good friends, you're probably going to get the same answer from everybody. That doesn't necessarily mean it's the right answer. So you need to go outside of, when you're looking at these technical studies, that you're not looking at correlated studies and using them to confirm each other. It could be 2 or 3 different studies on momentum that are all catching the same numbers, but aren't really telling you anything differently. So don't be fooled if they seems like they're all indicating one thing when all they're doing is agreeing with each other. I think, Kim, and George, I think Steve Nissen and Steve Bigelow, I think we've used both of them in our with OU. Also, look at charts from different time frames. We're going to take a look at this as we next get into trading styles. What do you think works for you? But I'll use charting to find something, and what I normally will do is I'll zoom in or zoom out on my time frame to see if there's anything that I might be overlooking. Of course, I have the luxury of also being able to pick up the phone or hit our instant messaging system and say to Wayne or Ryan, hey, you guys seeing what I'm seeing? It's nice to have that luxury of having 2 expert chartists to back you up. And I use that a lot of times, and I've said this a number of times. A lot of times I'll use them as my backup to make sure that I'm not stepping off the curb into traffic and missing something. We had a situation like that in our practical applications class the other night. I was looking at a stock Again, for educational purposes only, we had a position on in PCX, Patriot coal. And you know what? As a way to show you what I'm talking about, I think this might be a good way to segue into trading styles. I'm going to bring up my Thinkorswim and show you what. Actually, let me go to the next one, just because I wanted to make a point here. In general, this is what my charting package is going to look like at kind of its default setting. You can see this is just falling off the cliff. This is David Elliott's 200-day moving average, the thick red line, the 50-day moving average, and here are his MOBO bands. And if you notice, this is the pound dollar that about 10 days ago, we'll say, this thing got outside of the MOBO bands right about here. And what I'll do is maybe I'll try to bring it up more clearly when I go live. But you can see it's pretty much ridden the outside of this MOBO band the whole way down. So if David had initiated a position, he would have initiated it up in this region, and he would still be riding it because it's still, nothing's changed for him. It hasn't gone back through those MOBO bands. I'm going to go actually on live, and we'll take a look at that one, and I'll point out make my other point about using anybody who's thirsty. Here's another look. First, let me look at that chart again for you, just so you can see. And good, I still have the chart up. Let me close down my account with my $52 million in it. Again, anybody who's not familiar with that joke, you can have $50 million in your account too. All you need to do is know how to set it up. Here is that same chart that we just saw, big and wide on your screen. And trying to show my point, right in this area, probably back the end of July, David would have seen, okay, wait a second, this thing's closing right about the 31st, closing right about at the bottom of my MOBO band. He would have gotten interested up in here because it would have crossed the 200-day. Right here, it bounced off the 50. Probably, I'm guessing, I don't know if David even has a position in here, but this ends up being a classic example. And if he doesn't have a position in, I should probably email him and have him print this chart up so he can show people. It works out being a great example for him. But you can see that he's got these MOBO bands. It's the red band here and the red band there. And once this is broken outside of the MOBO band, it's broken through the 50, it rides along that MOBO band all the way down. And even down here, it's kind of, it looks like it's trying to get back through the MOBO band, but it really hasn't, followed through. So this is an example of how you could use the MOBO band in conjunction with the 50-day and the 200-day. And you'll also notice that on the RSI, this thing is way, way, way oversold. So you would expect that you would get some sort of a bounce. David, no, they're not standard on TOS. If you want to send me an email, if anybody does, I'll try to type out the directions on how to do it. It really, I think you can probably go into, let me think about this. If you went to here to chart settings, that's not it. I'm not going to waste the class's time. If you email me, I'd be happy to either get you on the phone and walk you through it. It's very simple. You're really just changing you can see the numbers here. You're just changing the calculation of the bands. No big deal. I'd be happy to do it for you. But again, this RSI is really oversold. And for those of you who know me, you would imagine that regardless of any of this, you would say, geez, Greg probably just wants to get long because it's been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days down, 2 mildly days up, another day down, this thing's sitting sideways. Just from a pure bounce back, I would take the other side and want to say, geez, is this someplace I'd want to maybe get long? Again, that is for educational purposes only. I'm not telling anybody to get long the British pound here, but for me, the first thing I'd notice is all these down days in a row, just they can't go. They normally not that they can't. They normally don't go down forever. So you probably are going to see some sort of a bounce maybe before it would move lower again. I'm going to make the other point that I was making, that looking at a couple of different things in PCX, we had this position on, and the stock split, and we were long the 50-45 put spread from August. Trade was profitable. Let me see if I can get it in really tight, because we did this just a little while ago. And there's expiration. So it was right about here. And what had happened was I'm looking at the chart and had seen some indicators that showed me this thing looked like it might want to bounce back. And we had a profitable trade. So I suggested to our practical applications class that we put on, we continue in a bearish mode with PCX. Because we had made money, we had 20 contracts on, we took 20 off, we took 10 of them off for a profit, and we rolled the spread out from August to September. And my thinking was, well, we've got a profitable trade, we can do this, we can stay in a bearish mode, and I'm not a big believer that we are going to get, I thought we could still get a continued follow-through down in oil. So those sort of things, being able to continue with a winning trade, stay in the position, it looked like when you pulled it back on a farther level, let me see if I can get it to do that, a little bit farther back out. These are actually candlesticks. Let me change these because it's a little easier for this to read when it's not candlesticks. We make them bars. Just a little bit easier for everybody to read. So that's okay, and unless I just can't see it. I can't see. Oh, there's the okay hidden at the bottom of my screen. Okay. So anyway, I came up and say, here's some reasons why I think we should, stay short. And Brian and Wayne pulled up the chart and found that this level right about here. Let me see if I can draw a trend line in there to give you an idea what we were talking about. Drawing a trend line from about here. I want to draw a trend line for me. That said, they said, well, hey, Greg, wait a second. Take a look at this thing. It's sitting on support. We may not want to do this trade. I was like, oh man, you're right. So what I did was I kind of reevaluated and said, look, I want to keep the spread on for all the reasons that I talked about, but I'm not going to let this thing get away from me. We were in it at $1.50. I said if this thing collapses down to say 75 cents, 50 cents, I want to get out. So it's actually moved down towards that level because it's bounced off that support level. But my point being that I was looking at it from a couple of more fundamental reasons, took a look at the chart, liked the trade. It was like the fundamentals of oil maybe being weak. But upon further review, Ryan and Wayne said, hey, don't forget about this support line, which I had missed. So point being that more eyes on a trade, the more things you look at help you when you're trying to put on profitable trades. We did keep that trade on. We actually were able to the next day leg into we now own the 50-45 put spread at a credit. What never happens is I put an order in to leg into the spread in the morning, and the stock dropped down. They put the spread on for a great price, and then it went back up. So lucky trade. So just an idea. I just want to let you know that's the kind of thing I'm talking about. Taking another look, more eyes on the trade. Let me go back to my computer screen. Actually, no, let's go back to my documents. Here we go. Trading styles. I'm going to overly simplify it and break them down into a long-term trader, somebody, and you know who you are out there, who likes to hold positions for weeks to months, maybe even longer. If Raz is listening somewhere, he's nodding his head right now. He is a consummate long-term trader guy. All things equal, he'd rather get a position on and be in it and let it sit there. Because he takes so much care to put a position on that he likes to stay with it as long as possible. Medium term, I'm going to define that as positions days or more, maybe even a week or so. And then, as George said earlier, the ice water in the veins guys, holds positions for a day or less, maybe less than an hour. All these styles, you could at any one time, depending on the position, work in and out of these. You don't have to be a short-term, long-term, pigeonhole yourself. I've been known to take a trade on and off, as quickly as I can, and there's other times where I'll stay in trades longer. It depends really on the objective going in, and you're reevaluating. It's the decisions that you make as a trader all day long. Every time you decide not to do something, that's a decision. So omission as well as commission. By choosing not to do something, you're still doing something. And those decisions, when you're watching a position all day, are constant. We would, as floor traders, find ourselves literally tick by tick watching positions. And some people, part of the reason why we had people on the floor who didn't make it is they just couldn't handle, and it's not nothing against them, it's just that their personality was not such that they could sweat every tick of the stock. We had a guy who came to work for me. We were going to hire him as a clerk and teach him to trade. We had trading Ericsson, which is the handheld wireless cellular company, and we had earnings. Well, at that point, there was only it was only the specialist and I making markets in that, and earnings were coming out, and we got a little bit busy. It wasn't crazy busy, but it was busy, and I would keep looking over. He was standing off to the edge of the crowd, just kind of looking at me, and I could see he was getting nervous. And I was like, "Oh, this isn't a good sign." At the end of the day, he wasn't even trading, and the guy was all sweaty. Man, what's the matter? He's like, I can't do this. I'm like, what do you mean? It's like, I wouldn't put you in. I'm not making you trade today. We wouldn't set you in unless you're ready to go. He's like, no, I can't do it. He was not somebody who, he recognized his trading style. He came from a desk where he traded energy, and it was a much more slow pace. So you have to know, you can't make yourself a day trader. You can't make yourself a long-term trader. I couldn't hold positions for weeks or months. It would drive me nuts. I like to do stuff. So you have to, at the beginning here, try to figure out what's going to work best for you. Long-term profit targets, you're anticipating large currency pair moves. You have the capital reserves to wait out your position. You're looking for hundreds and hundreds of pips, maybe more. If you're a long-term trader, you're going to look at a chart like this. We've got a 2-year Aussie dollar chart. This is back a few months ago. If we could continue this chart, you would see that it would go like this right after here. But for example, if people would have been able to put on this position and just, if you had a long-term perspective, you'd have been able to ride this thing for just, up for just a gigantic move, 2,300 pips. Breaking it into a 1-year chart, again, you'd have gotten a little bit more nervous, but again, bottoms to tops, got a significant move. If I were trading this, it would have been, in and out, in and out, in and out, in and out. That's my personality. That's the way I trade my capital. Medium-term profit, you're going to anticipate moves in the currency pair. You're looking for 100 or more pips. You want to make sure it's a sizable move. You're probably a person who's going to be trading multiple positions, and you can do this with the currency options as well as the spot. You're going to be someone who's actively managing the daily position. You may have this 2-hour chart up and say, man, 2 hours, perfect for me. Love this trading style. This is what we're going to work on for. This is how I'm going to keep an eye on my position intraday. You can also give somebody, here's the short-term trader. Short-term profit targets. This is what we might call a day trader. Finds a pair and time of day to specialize in. This more geared towards trading, you would think, strictly currency cash or spot. I'm going to show you tonight at the end of the class a way that you can couple an options position with a spot position to allow you to trade at more times during the day. Day trading, I remember I was friends with the guys who probably they coined the phrase day trading. Some of you that may have done it may have the book sitting on your shelf right now, The Electronic Trader by Mark Friedferting and George West. They were traders that I knew from the American Stock Exchange. Surprised the one guy had trouble getting the lunch orders right. Next thing I know, he's on CNBC and worth a gazillion dollars. Nice guys. They were backed by the same gentleman who originally backed me at the Philex. Actively in and out of positions all day long. Looks for repeat small wins. Sets a daily profit goal. There are traders out there who say, you know what? I need to make 1,000 pips today. I need to make 500 pips today. And when they do that, they're done. I need to make $500 or $1,000 today. If I can make $1,000 a day, I'm happy. I can pay my bills. And they make their 1,000 and they walk away. This is the one. I think the style of trading that you need the most discipline, because you're going to be in, you're going to be out, you're going to be up, you're going to be down, and it's a grind. Again, most of you, because you're trading a currency options, taking a currency options course, you're not probably looking to be a spot trader full time all the time. You're trying to see how can I maybe use foreign currency options in and of themselves with profitable options trading strategies, or can I couple them? As I said, we've got something coming up that I'm going to talk to you about where you can use the two of them together. Yeah, this is a hard way. This is really work. If you go on, I believe it's on Comcast.net, and they offer recorded TV shows if you want to go watch the old, emergency shows and, Knight Rider, and they have new shows and old shows. You can watch full-length episodes. Well, there's one on there called, I believe it's called Wall Street Warriors, a very, very interesting TV show that they did. And as I'm sitting here, I'm going to see if I can bring up the link for everybody. It's a very interesting show, and the only reason I think of it is they talk to hedge fund guys, and it's almost like a reality show. Being in the business, I find it very interesting, but particularly since they followed a couple of day traders as part of their show, and it's interesting to see how tough it is for those guys and women to make money, and how they. Let me see if I can get you this link really fast, because it is interesting in anybody's free time to go to take a look at that. Where is it? More full episodes. Hang on one second. I'll bring up the link for you. What's it called? Wall Street Warriors. They're not very long. I don't know if there's the link. Just really kind of something as a complete diversion. They have a number of episodes on here, some older, some newer, about all different people on Wall Street. Just an aside, something I think you guys might like, but the idea of day trading brought it up because I remember they literally showed a woman who was learning to be a day trader and how difficult she had it trying to get in and out, in and out, in and out. I mean, they're literally flipping for, whether it's stocks or currencies, 2, 3, 5, 10 pips at a time. So take that 500 or 1,000, you're looking at 50 to 100 pips on a $100,000 contract. And I really believe it's a great way to start your paper trading account, either trading it straight or the idea that I'm going to give you at the end tonight of how you can combine options and spot. We had someone specifically ask me, so I pulled out some research that I had and put something together for you guys to use in that to use for your trading. Yeah. Paul, I wouldn't know about golfing. Yeah, I'm 6 years ago. That and the fact that I have 4 little kids. And George, you now have picked up my favorite person, my favorite character from the movies. Love Gordon Gekko. It's, as Bud Fox said, life comes down to life comes down to a few moments, and this is one of them. The way I could beat Tiger is if I could get him on the Wii. I have shot under par at St. Andrews on Wii, but that's about it. I think even Tiger's really, 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 really good at his own game. Someone interviewed him recently, and he said now that he can't get around, he's been playing his own video game and, shoots like, 60. He's just unbelievable. Here we go. This is the kind of chart you might be looking at, a 2-day, 30-minute chart, if that's your style, or the old 10-minute chart. You may even zoom it in more. Here's what I believe, and I said it right there in the open. The key to successful trading is money management. People really, really have to believe that I know lots and lots of guys who were brilliant theoretical guys who could espouse option and trading knowledge that would just blow you away. But when you put a position in front of them, they just couldn't trade it. They'd let their losses eat them up inside and eat up their bankroll, and they'd be too quick to try to cash out profits. I've said it before. I will say it again. It'll be one of those things that when you hear someone talk about it, or you hear me start the conversation, you'll be able to finish it for me. It doesn't mean it's not true. Each trade should be entered with a profit target and a loss limit. Doesn't matter whether you're trading spot FX, you're trading futures, you're trading options. Got to have a plan. I'm going to borrow a phrase, a concept, an idea that's been used from Anthony Robbins, motivational speakers, Dennis Waitley, all sorts of people, always one way or another come around to the same idea. If you were going to drive from your home to the beach, wherever you live, and if there's no beach in the area where you live, indulge me. If you were going to drive from where you are now to the nearest large body of water, you wouldn't just get in the car, leave your house, and just start driving. You'd probably put your GPS on now these days, or you would get a map. You'd have a plan. You wouldn't have any hope of getting there if you didn't know where you were going. Same thing's true with trading. So that doesn't mean you don't adjust your plan to allow profits to run and stay in winning trades. The one thing you never want to do is you never want to increase your loss limit in hopes of a directional turn in the spot market or the underlying. When spot, I mean the underlying market. If you set a loss, take your lumps, get out of the trade. And guess what? There's nobody out there listening to me right now who, to this point in their trading career, has taken more losses than I have. It's part of the game. You end up getting your brains beat in. It's not a lot of fun. Nobody likes to do it. It happens. Like that. Kim's a 14. Oh, man, she would just kill me. Of course, I think my 9-year-old son, who's just starting the game, would beat me. Yeah, Kim, I want, if you bring me out of retirement, I need like 6 aside at least, maybe more. If you're trading FX, people will say to me, Greg, well, how much money do you need? I'm not here to tell you that you should put this much money into your trading account. Let's just say for your paper trading account, this is what you're starting with. You may, $5,000 may be a drop in the bucket to you. $5,000 might be all the money that you have. If it's all the money you have, I don't want you putting it in the market. If it's a drop in the bucket, maybe you should put a little more. I can't tell you how much to start with. I'm just going to kind of show you how the math works. To do spot trading, you really wouldn't need as much money, probably because you're going to be in and out of the market quickly. Your risk tolerance and your profit targets. Risk tolerance is about 5%, then that's how much you should be willing to lose on any trade. If it's 2%, the same idea holds. And you want to stick to this idea to start. And you can change this, but this is something for the beginning I think you should use for your trading. 2-to-1 target. If you're trading, you want to trade those 10,000 base unit mini spot contracts if you're going to trade that way. Let's say you're looking at options, and this is where the pips are $1. So it gives you a lot of room to be wrong. If you're going to look at the world currency money management, let's say you've got $20,000. Again, $20,000 might be more money than you've ever had in your life or all the money you have. I don't want you putting all your money in. I'm just using this number as a guide. But the same rules apply. You have to come up with a risk tolerance. The reason that I took 5% or 2% is you never want to have all of your eggs in one basket. I know that's cliched, but you can't put yourself in a position where any one trade can take you out. It's the reason why we are so adamant about people not being net short options. That's a position that can expand your risk to the point where you can blow out your entire bankroll. So if you have a 5% risk tolerance, that means you've got 20 chances to be wrong before you've blown through your bankroll if it's $20,000. You've got much more than that if you're 2%. You've got tons and tons of times to be wrong. For Elizabeth, I'd be happy to do that while I'm talking here. No problem. It's the same math works. It's just trying to take, hey, you know what? Geez, I'm embarrassed. Oh, no, that's right. Yeah, the risk tolerance is 100 and your profit target should be 2. I'm sorry, I'm looking at my math backwards. Again, that's the point I'm making here on both of these. Are you okay, Elizabeth? You're caught up with us? I'm sure she's not the only one who didn't get this information, so we'll take a minute. I would sing here, but that would be cruel and unusual punishment to a captive audience. Numbers are going to apply when you start with 20,000 up here. These are guides. Great. Thanks, Elizabeth. Yes, George, everything on the Secure Viewer tomorrow. What we're trying to build in here is the ability to be wrong. I'm sure that all of you have seen or heard people, other companies who want to teach you how to trade, and I know one in particular that promises you that they are going to be able to, what was it? Was it double or triple your trading account or your money back on their course? Some just outrageous claim. I was at a show and someone came over and said, well, these guys are promising that they can make me money. I said, well, are you telling me that because you want me to say that, or are you asking my opinion? They said, well, what do you think? I said, well, I'm not a believer, and I normally would run. Exactly, Paul. I didn't see your quote, but that's exactly what I was about to say. I was leaning back and I thought, run is exactly run far away. And it's a well-known company, and I'm trying to build the base for your trading that you can be wrong, you will be wrong, and you are still in business. That's the key. Be wrong and still be here tomorrow. So here's what I'm going to show you the math. There you go. Thanks, Gabriel. Please don't type in who that is because I don't want to badmouth anybody. Thanks. David, it is 10's the average. You know what, David? What we'll do afterwards, maybe what we'll do is after the class, I'll either open mic or I'll just walk everybody through how to set up the Mobo bands on their Thinkorswim. So you can kind of follow along. We'll do it after class. That'll be a great exercise. So, again, we're here to make sure that you are around for a long time. So here's what I did, a little math for you. If you take this 2-to-1, some of you have seen this before, what percentage of winning trades do you need to do just to break even? I'm making this a math test, so I'm going to show everybody. 33%. Now, we're not here to help you break even. But here's your example. If you had 10 winners and you made $20,000, you had 20 losers at $1,000, you're scratch. So what we're showing here is that if you can hold to a disciplined money management style, you can be wrong a lot of the time and still be a net winner. Now, Ron likes to say that, people say, well, I win 80% of the time and I only, make $1, and when I lose the other 20% of the time, I lose, $100. That's not a good plan. Am I telling you that you need to follow this absolutely strictly by the book? No, but what I'm trying to show you is that if you do this, particularly on the loss side, if you limit those losses, as tough as they are to take, and if these 20 losers are all $1,000 or less, you probably are going to feel, because you've got your downside and you're confident you can take off losers, it lets you know that maybe what I do is roll up an options position that's going my way, take part of my profit and try to take it a little farther, play with a little bit of the house money. I'm a fan of trying to do that, sometimes legging into positions, but letting the winners go your way, not blindly saying, well, until I make, as our example, until I make $2,000, I'm not going to take any profits. You're then leaving the power of options at the side of the road, and that's not what you want to do. So I'm just saying you should use that as your target, but in particular concentrate on making sure that that downside number is firm to keep you in the game. And this concept of money management with the numbers prove that you can be wrong more than you're right and still profit trading spot Forex, trading options, trading equities, trading anything. The question is, do you have the discipline to prove the numbers right? So that's the thought right now as we get ready to start talking about trading strategies. Can you take the concept of money management and use it to your advantage? You don't need to all jump in and say yes or amen or whatever your choice is. It's a concept that I sometimes believe, actually not sometimes, I do believe that you will find people in this business, when I say the business, I mean the education business for trading, and they try to say that everything is kind of mystical and complex and they're the only ones that understand it, or they take it the other way and say that, oh, well, it's just look for, green arrow, green arrow, green arrow, and you're ready to go. And I think the truth lies somewhere in the middle, and that's what we try to do here at OU, is give you the tools. And I think not enough people talk about money management, and they should, because you can have the best trading strategies in the world, but if you can't manage the winners and particularly the losers, you're going to be looking for another job and you're going to be trying to find more money. Yeah, you're right, Kim. Nobody wants. Well, it's ironic that you should say that, and I'm going to bring this up because we had somebody who emailed me yesterday. We're a full disclosure shop here, and they expressed a little bit of disappointment, and some of you might actually feel the same way, that we didn't jump right into me teaching you how to trade currency options and make $1 million by next Tuesday. And I just don't believe that that's the way you educate people. None of you that went to college or in high school walked into your first day of class, and as the professor or the teacher laid out the plan for where you were going to go for the year, said, oh, that's great, yeah, but let's get to the meat. Can we get to the good stuff right now? They would have said, well, all in good time. And we're at that point now. We've laid the groundwork. We're going to start talking about trading strategies. I've got a couple basic ones we're going to talk about now, close out the night, and then we're going to come back on Monday and really dig into this thing. Dave's got a jet, guys. That's cool. You're right. It's we at OU are kind of torn because there are people out there who are pumping the hype, and in particular, mean, it's not my style. I'm going to tell you what I think you need to know, and if you know, whether some of you know it, some of you don't. I'm going to tell you what I think. I'm not big on trying to tell you what I think you think, what I think you want me to say. I'm just going to tell you what I think, and you know, sometimes you're not going to agree with me, and that's fine, and sometimes you will. So let's take a shot. A couple trading ideas, trading plans, specifically geared towards the world currency options. I gave you the trading styles as long-term, medium-term, short-term. We're going to start at the end and look at short-term. When we talk about short-term currency options trades, we're talking about the purchase of a front month at the money or slightly out of the money option. This particular idea is geared towards a very, very short-term trade. None of these concepts. Do you want to put the carry trade on, Dave? Or do you want me to go over it again? Good, because there was somebody who was beating me up for doing that. So I'm glad someone's got a sense of humor out there. Appreciate it, Dave. So what we're talking about here is, and I'm not going to tell you, for the educational purposes, you've identified, you know, a move that you're looking for. The one that I'm referring back to is, I'm going to bring it up again so I can show you on the screen. Where did my screen go? There we go. I'm going to share my screen. Won't get to see the big pint of Guinness this time, but because it's an educational class, I'm going to take the liberty of being able to look backwards and know that I'm right, which helps. I know sometimes people want me to make predictions as to where stuff's going to go. To make sure that you all get the education, that really looks lousy. You know what? Let me close. This really looks bad. Let me clear off. I'm going to clear off David's stuff. Delete all studies. Okay. I'll even make it candlesticks for everybody that likes the candlesticks. And we move this up here, and we hit apply and OK. We've got some candlesticks. And what I've done is you can see that this was August expiration right here. The type of trade we're talking about is if you found yourself back in this area, you know, and for my example, I picked the 8th. So this thing's getting beat up. Maybe it's made a little bit of an up move, but geez, I'm not a believer. I think that this downside move could continue. I don't know how long, but I'm hoping to get a little bit of a run out of it. So this, just mentally keep in mind, we've seen this downtrend. We're looking for a short-term trade. We don't plan on being in this for a very long time. We're trying to catch a quick move, but we don't want to take the chance of exposing ourselves to a spot trade that could get away from us quickly and lose us money. So let me go back to the PowerPoints. So now I just wanted to context the chart that we're looking at. So you're talking about the purchase of a front month at the money or slightly, and when I say out of the money, I mean slightly out of the money option. What's the objective? We're really not trying to get a trade on here that's going to put a lot of money on the table for us to lose. Kim? No stock replacement on this one. Not what we're talking about. No 85 delta, and I'll tell you why. What we're looking at in this particular trade is you think you can catch a short-term run, and but you're not. You don't have any aspirations for a long-term move. So I know that Ron is a huge fan of playing direction from the 80, 85, 90 delta area. This is a strategy that I like to use that, you know, if you've ever seen me live or giving opinions, I'll use this a lot, where I'm going to try to catch a quick move, be in and be out. So here's what we're going to do. I'm going to show you. Let me keep going here. What we're doing is we're trying to limit our risk by not putting a lot of money on the table for this trade. If we'd done this with an 80-85 delta, we're talking multiple dollars on the table. A quick turn, even in a week, particularly for with the short term, can be a bit of a problem. To me, in this one, the Greeks are not that much of a factor, even though the example that I'm giving happens to be a play that is about a week till expiration. You're basically buying extrinsic value, but you're buying it at the actual dollars themselves are low. So you're not putting a lot on the table. So you're not really concerned about as much time, implied volatility, the normal things you look at. What you're looking for is low-cost way to get in, leverage, and using, let me see, Bob's not seeing anything. Has everybody else got me on the screen? I think I switched back to my other screen. I want to okay, everybody's got me, good. Don't anybody else type yes because I want to check these answers that everybody's written. Everyone's typing yes. Thank you. I just want to make sure I'm getting these couple questions that are here. Hey, George, a breakout and breakdowns are 50 delta. Yeah, I'm looking at that type of a trade. Maybe I'm looking at 50 delta probably or less. This is really truly a quick hit. This is just you think you've got to move. You're not overly confident. Expiration a lot of times, and trading around expiration can magnify moves for a lot of reasons. Normally in stocks you see it more where pin risk becomes a reality. A specific line has an open interest that is large, and I can't give you the scientific proof, but just having watched it, and particularly when you're long the strike, always seems like they want to go pin the strike. So you can, in these short-term situations, get movements that move outside the convention of normal, but week to month short trading. I'm talking, this is not spot trading, cash in and out, but it's pretty much the next best thing. You're using the power of options because you're using leverage, but you're able to do it in a regulated market. You're leveraging the value of options. You're not putting a lot of hard-earned money on the table, but you're looking to get a quick hit. Here's the example I came up with that we talked about. I showed you that chart. This is dated, if you can see up here, for those of you that have a big enough screen or the resolution's okay. This was 2008. Hey, the day the Olympics started. I didn't even realize that. And that's the chart. I'll toggle back I don't have to toggle back. That's where the chart date that I showed you. Now, you could have bought the 191.50 puts. They're about a 45 delta, as you can see right here. Implied volatility, not really a factor at 9%. The last trade was 192.16. Again, I realize that I'm telling you, I'm looking back in history and saying, you can all assume that this is a winning trade. I'm not going to give you an example where I end up losing money on it. But this is the type of trade that you can see, particularly as you get towards expiration. And that applies to equity option trading as well as world currency options, as do a lot of the strategies that we'll talk about. Some are specific to our equities, some are specific to the world currency options and spot trading. But this one works. And this is, you'll hear Raz or Ryan will say, this is a cheap play. So you pay 92 cents, you buy this put, buy 10 of them, you put $920 out on the table, see whether you can get a downside move. Now, fast forward, this was Thursday, fast forward to the next Wednesday. Now, no laughing from those of you who know me, but if Greg did this trade, 8.8 purchase, I paid 92 cents for 10 XDB August 191.5 puts. 920 debit,
4 days later, I see a 2 bid, bang, out, done. A $2,000 credit, minus your $92 debit. You've accomplished a quick turn, made $1,000. The idea would have been on this to probably try not to lose more than half of the premium that you paid. So if that put had gotten to be down to 50 cents or so, the concept would have been to sell that thing out, taking about, again, that 2-to-1 trading idea. Now, I realize that you're all sitting there saying, yeah, Greg, great. You go back into Think Back, which is a great tool in Thinkorswim, and give yourself a winner. But what we're talking about here is a style, is a strategy of looking for cheap options where you can possibly gain quick money, particularly with the way currencies move. Now, again, this does work for other ones. Now, there's another way you could play this, given that, and if you wanted to play it more straightforward, instead of being, the guy like me who takes that $1,000 profit and runs, 2008, same purchase, same credit. If you waited a couple days, you could have sold those things out at $4.60, making a $3,680 profit. Now, here's, I think, the question that needs to be answered. Greg, why would we want to do these kind of trades? Absolutely, Gabriel. I would have probably done about, in my mind, I probably would have had, once it went 50-cent bid, and it looks like the future, the underlying's running away from me, I would have turned and hit the 50-cent bid and gotten out. We've got 2 similar trades on right now in our practical applications class that any of you who are in that class may remember. We've got 2 trades on. One is, again, these are for educational purposes only. Please don't go running out and putting these trades on because, hey, Greg told me Royal Bank of Canada. Of course, I got long Royal Bank of Canada, bought September calls with the before all the financials started getting whacked the last few days. And it's getting to the point now where I may have to take my medicine, lost about half of my premium, and get out of it. The other trade we have on, IGT, similar thing. We have October calls on in there. They're a couple dollars out of the money. It's not an expensive trade. The chart looked pretty good for both of them. Again, I didn't put it on the chart, but you would definitely want to have, you probably either, if you're not going to watch it all the time, put a stop loss in on the option and just, you bought the option, bang it out, and get out of the trade. Now, this is a little bit more, you're not going to hear Ron probably tell you to trade like this. That's why we have different instructors. Everybody's got different styles, and this is one of the things. Yeah. Now, again, I picked the absolute high, Dave. I admit that to make my example. But there was profit in that trade with going into it a relatively small risk window. So you're going to say to me, Greg, well, why trade this type of trade with currencies, world currency options, instead of just jumping in and doing a spot trade? I'm sure all of you are thinking that right now. The built-in limited risk, that trade happened to go over a weekend. So the futures market, the underlying's not trading. So if you have a cash position over the weekend, yes, you could have a limit order out there or a stop order out there that could take you out on when trading opens up on Sunday afternoon or evening, depending on where you are. But you never know. So the options let you sleep. Makes it a little easier for you to know that when you're wrong, and talk the importance about being wrong, how to get out. It can minimize the effect of a short-term swing. Now I'm talking about, it's gone against you, it's come back in, and you still believe over your time horizon of maybe a few days or a week that you're going to be right, but you're not getting shaken out, particularly if you've got a winner and you followed the stops up behind it. You're not getting shaken out. We've proved that point a little bit earlier. And the other reason, and I'd like to use this as a jumping point. You could either take your profits, move on to your next trade, which is a completely acceptable trade after you've made money. And I think that we spend a lot of time, this is nothing against morphing a trade, rolling a trade, but we sometimes forget to tell people that closing a trade is a completely legitimate answer. In fact, that's normally the first question I want to ask myself if I've got a winner. Do I just want to close this trade out? And if you can't come up with a reason why you want to stay in the trade, there's not an overriding reason. The trend is still going with me. I'm outside my MOBA bands. You have a Fibonacci reason, a support reason, a fundamental reason. If you can't do the normal due diligence, and I like to look at that as it's almost like you start over again. You say, okay, I'm now at this level with this trade. Would I enter the trade here now again? The answer is no. Sold. Get out. Take your profit. Go find another opportunity. But if you do, sometimes it's a way to allow you to leg into a different, better, longer-term trade with having put less money at risk. Let me flip over. I'm going to use ThinkBack to show you what I mean. This concept. Where is it? My computer screen. I'm now officially thirsty. The big pint of Guinness there. Getting towards 11 o'clock here on the East Coast of the United States. Here we go. ThinkBack. We were in the XDB. This is today. Let's go back to the day we talked about. Oh, no, I don't want to go to the future. ThinkBack's good. It will not let you predict the future. That would be really good. When we get that one, I'll let everybody know. Correct, Gabriel. If it just went sideways, and you'd probably get a good feel, what I was trying to do is jump on the trend in this sort of a move. You know, maybe I didn't see it at the beginning. I don't want to risk a lot of money, but I still want to try to participate. You know, the idea of putting when you're following particularly a trend like we identified, let me see if I can bring it up for you to look at. You know, this is where we put it on, right in here. It's the kind of, you know, we've had a bit of a comeback day, but do we believe in it? Maybe, maybe not. My concern with doing a large dollar premium, large delta trade right here is that if I get short and buy puts that are deep in the money, and this thing decides to run, I have more dollars on the table. If it's that 40-45 delta with a low volatility and it's 92 cents, I'm only on the hook for 92 cents. And you know, with a week to go, I kind of figure my worst case is there's got to always be a quarter bid out there for something. I can get out of it, take a little bit worse beating if I missed it. But yeah, I'm not looking at this. Yeah, think forward, Dave. I would love that. So yeah, you're willing to make that risk assessment. So here's what I was going to show you. If we go to ThinkBack, and here are the August options, 1 day to go. We own the 195s, 191 and a halves. You might be able to say, hey, you know what, Greg? Instead of selling these out and taking a profit, what I want to do is I still think the British pound is going to – I think we're going to see a decline here. I think it's going down. So what you could now do is, and any of you who are aficionados of Mr. Ianieri's classes or Wayne or Ryan's, you're going to know we're in the 191, so figure we could sell it out for 460. We could spread this and use it as a way to leg into. When I say leg into, it's legging into normally would mean maybe leg into a spread by doing one leg and doing the other. What I'm using it as kind of legging into another option. So let's say we have 460 in our pocket. Still want to be short, but let's go something that's, you know, maybe a little deep in the money, got a little bit more in the money. We'll take this at the money. Right here. We pay 286. So we sold it at 460. We pay 286. We take our $1.74 profit, put that in our pocket. That clearly works against an initial investment of 92 cents. We make 174. 194. No, 174. 174. And we're now still in the trade. In my mind, we own this one for free. And that gives us the ability to make more decisions. We'll talk about next week doing a spread. Do you maybe want to buy these and sell something down here, reduce your premium, but still allow you the ability to make a trade? So it can be a trade in and of itself, or it can be a trade that leads to another trade. But all in all, what we're trying to do is limit our risk because we've identified a very short-term potential move in the underlying, in this case, the British pound. Back to my documents. Okay. And we had a specific question last night, and I was emailed, I think, the same question by someone else. The answer that I gave last night was not 100% accurate. Again, I'm willing to admit that. I'm wrong. Sometimes I'm wrong. Someone asked specifically about the world currency options and spot FX. I alluded to the problems with trading both of those instruments from a brokerage standpoint and such. And what I've done is I went and pulled, like I said I was going to give you this at the end of the night, I went and pulled up an Excel spreadsheet that I use. It is, I'll tell you now, I'm not the master of the Excel spreadsheet. In fact, my old boss, a guy I'm friends with, is, and I may send this to him and ask him to work his magic. He likes nothing better than cranking on an Excel spreadsheet. But it is functional. And what I use it for, and I'm using it now for our class, is a way, since the world currency futures are not a viable option on thinkorswim right now, there are two ways you could hedge an options position. One, use deep in the money calls, deep in the money puts. I'm sure some of you have seen me I've done talks on gamma trading the world currency options. And I think it's a viable option, unintended, to use deep in the money options, calls and puts, as your hedging vehicle for a long gamma position, particularly if you're trying to do gamma trading. We're going to speak about gamma trading on Monday. That's why I want to kind of set the scene here as we get ready for that. So you can use spot FX cash market that trades 24 hours a day, 5.5, 6 days a week, in conjunction with your world currency options. You're probably all getting a preview of what I'm going to write my next article for our newsletter in September. It's probably going to be the topic of my newsletter. In fact, if any of you have got our July-August newsletter on email that you could email me, I would appreciate it. I wrote an article, and I never got a copy of it, so hoping I spelled everything correctly and that it made some sense. But if anybody happens to have that, probably just grab it from Brett or somebody, but just reminding me that I haven't seen a copy of it. So here's what we're talking about. How can you combine two things that at first look don't really seem to go together? How can you develop a strategy where you can use both of them? And there's some interesting advantages and concepts that you can use. You're combining the power of the Philex World Currency Options with an easy hedge today. Today is the important thing. When we get the world currency futures traded actively, that might be your better option, and I'll explain to you why. It also can provide you a chance to trade the markets day or night. Some of you that are around the world don't necessarily want to be tied all of the trading day in the United States, 9:30 to 4 o'clock our time. For some people, our friends say over in India or Singapore, Far East, that's going to bed and sleeping time. Opposite side of the world. So combining these two gives you a chance. Don't forget Australia. I'm sorry, I forgot Australia too. Oh, good. Nobody's gotten it yet. Maybe that means that so you won't be able to tell whether whether my spelling is correct, and they put graphs in and all that kind of stuff. So they told me it was out. I guess they're not. So there's a way you can combine these two to trade them both, and I think it's an interesting take on spot trading. Carry a long option position with the added earning power of hedging or trading around your position. Some of you like to call it gamma trading. It is not, I repeat, not a perfect hedge. The perfect hedge for the PHLX world currency options are the PHLX world currency futures. We're going to go into that in a little bit of detail. Well, Joe got his. They must like him better than me, which isn't a surprise. You're all now saying, Greg, man, this sounds great. I'm in. Let me do it. Well, with the good, there always seems to be some bad. So here's our world currency spot FX hedging pitfalls. The options do not settle to the hedge spot position. What do I mean by that? Well, I just said that it is not the perfect hedge. The world currency options settle to cash. The world currency futures settle to cash. The spot does not settle. It is an ongoing cash market trade, which you could be on either side of American dollars, depending on which side of the trade you're on. So one does not convert into the other. When does that seem to be a problem? At expiration. Because when you get to expiration, you need to be prepared to roll your options and keep the hedge, close both sides. If you're using the matching future, they would both expire, same time, all settle to cash, boom. You end up with no position after expiration. If you let these options expire, they are not going to cancel out your hedge. So you would end up with your hedge in place if you didn't close them both out. So you need to be prepared to either roll the options and keep the hedge in place or enter two orders that would close out your option position and close out your corresponding underlying FX spot position. You do not want to let these options go to expiration. Now, a lot of times going to expiration with options as a retail investor is just not a good thing anyway. I a lot of times like to say just get them off, and you may want to keep until expiration day, not these, but equity options, because there can be some advantages of trading it, but you have the matching underlying that converts one to the other. If you're long a call and short the stock and the calls are in the money, the position disappears. It doesn't happen that way, so you need to be careful about that. This came up yesterday with one of my friends from Australia who pointed this out to me, and by the way, glad to hear that the Manly Sea Eagles are doing well this year. I may need to go on eBay and see if I can get myself a new Manly Sea Eagles rugby jersey. I have, fortunately, not by much, but have outgrown the one that I brought back 20 years ago. That cough was intentional. 20 years ago when I went to school in Australia. Gotten a little bit bigger and outgrown that one. So there are margin implications because I spoke today to the head of FX trading for Thinkorswim. We are going to put up Thinkorswim's, as you would imagine, Thinkorswim's website link from Option University at the end. These are not, because they're not a perfect hedge, they are kept separately in your account and they are margined separately. So there can be implications to your ability to trade. And in your actual trading account, you won't have the ability that I had to call the guy who's in charge and say, can you put $1 million in my FX trading account so that I can teach people how to use Thinkorswim's platform? And once he heard that I was using their platform, John was more than happy to give me, as Dr. Evil like to say, $1 million in my trading account. So there are margin implications, and you need to be aware of that. They are going to trade separately. What does that mean? Math, and more math. You're someone that likes everything neat, clean, and easy, and you like to go to your trading platform and see all your positions and know exactly your risk without making any sort of extra movements, this may not be the trade for you. If you're somebody who likes to – oh, by the way, there's no such thing as too much Guinness, Anthony. No. When we get to too much Guinness, I'll let you know. There's math involved, and this is really going to take work, but I think it can be profitable work, not busy work. And I'm going to show you what I need to track the position separately. So you're going to need to be able to look at your option position and your stock position, but you also need to remember that there's sometimes you may need to buy spot to hedge a long delta position. And you're saying, Greg, wait a second. No, if I'm long delta, I got to be selling the underlying. Well, because of the configuration of currencies, these three in particular, the dollar Swiss, dollar yen, the dollar Canadian, your world currency options are configured the opposite way. So there is a little bit of paying attention that goes along to make sure that you really are on the opposite side of the trade. If you were, for example, long an option position in the world currency option with the Swiss franc, Swiss would be the base, the dollar would be the counter. You would be long the Swiss, short the dollar. But your hedge is the opposite. So in this case, you'd need to buy the U.S. because you're short it on the other side and sell the Swiss. And with TOS as your brokerage, you're going to need to calculate and track the deltas by hand with TOS. The hedge for these, I forgot to put it in here, is the 10,000 mini contracts because it matches the 10,000 of the PhilX world currency options. Now, some of you were saying, Greg, come on, tracking deltas by hand. You know, I know you had to do it when you were a trader back in, 1989 on the floor at the American Stock Exchange, and down in Philly in 1993. Yeah, you're in Ron's crowd and you're sitting there with a big sheet of papers, but this is 2008. We don't track anything by hand. And as some of you might guess, we have Greg's, at this point, non-proprietary, take no responsibility for mathematical errors. I'm going to try to figure them out. World currency position and gamma spread. William, it can work. You definitely want to be trading front month options. You could even do this if you were, say, a month to expiration, and then the implication of the Greeks would even be less because time is not as much of a value. It's really when you have identified an opportunity that you expect to play itself out within a week or so. This is not anything that you see with a time horizon beyond there. If you see something that you expect to take a week or more, we're going to talk about strategies that you could use, but this is one that you could implement. And again, it was strictly an option trade without a hedge, just trading options. What we're giving you an insight into here is where we're going, which is using world currency options and the available hedge of the FX spot market to trade. And before I'm going to let you know that we've got there's going to be a lot of use over the next couple weeks of this concept as one of the hedging techniques for our trades. I think it's a very good way for a couple of reasons. I'm going to go over them real quickly. I'm going to kind of hit bullet points. I don't have a slide for this, and I'm going to show you this spreadsheet as our final thing before we close and then go to trying to help everybody get the MOBO bands or whatever else we need to do, housekeeping, but anybody who's done and the presentation. I think you can use them, and I'm going to show you how, as a way to trade the FX spot market from a limited risk hedged position, whether it be putting straddles on to acquire gamma and gamma trading. And that's really what I'm talking about in this situation. Gamma trading the world currency options. Quick overview. Again, we're going to do this Monday, but the idea of gamma trading is how much gamma or movement, gamma being the rate of change or the rate of change, and I'll try to lay out briefly the Greeks on that. I don't want to bore everybody, but I'm going to have to at least get everybody up to speed on what the idea of those Greeks are. But you can trade, put the position on, acquire, in this, our example, a long gamma position during the normal U.S. trading hours, 9:30 to 4 o'clock, but you can hedge it actively at whatever interval you choose at any time while the FX spot market is open. So if you're somebody who wants to trade very, very short term and try to make, flip a contract, one contract at a time for 10 pips, you could build an option position that would allow you to do that, knowing that you can only lose so much money. So let me show you. It is tricky. That's why, again, this is not like this isn't perfect, but it's beyond a beginner strategy. This is a more advanced topic. And what I want to show you here is I'm going to bring up, I'm switching to my other screen before we close, and I'm going to show you what I'm talking about. This is share my computer screen. Second monitor. No Guinness. Now, I'm going to have to do this so I can see this. Where is? Guys, I'm trying to fit this thing into the screen. I can't really see what I'm. My resolution on mine's usually higher, so it's kind of throwing me off. I'm going to let you know that this is not, like I said, I'm not an expert in. I can program in Excel to fit my needs. I am not an I'm not an Excel programmer. This is purely a functional worksheet, and I'm using the example here. What I've done is to be able to track my gamma, because when you go to, and let me show it to you, I'll bring up, geez, there's that Guinness again. When you go to Think or Swim, and I'm going to show you what we're talking about, you go to the monitor, and if I break them into capitalization, I believe it breaks it down a little better. Close these up. This is what I'm looking at when I put these positions on it. So I bought 100. I think my lean was just because the dollar has rallied so much and all these currencies have gotten bailed so big. I went a little bit. I went with a little bit more in the money, put slightly in each of these to try to get a little bit of negative delta in order to allow myself to buy some FX spot to just lean a little bit long. So I bought 100. If you look here, bought 100 straddles. And again, I'm going to use this spreadsheet as we go along to kind of track. Instead of using those individual FX trades that we had, I had to take those out before they gave me my $1 million of FX liquidity. So the Australian dollar, we bought the 87 straddle, and you'll see this again, but these are each of the straddles. Here are all my Greeks. Here's my delta, my gamma, theta, vega, my P&L so far, and that's on, again, this is the one-day trading, and I haven't, I'm not trying to put this out. I did all of them. I don't know if I would necessarily trade, if I was gamma trading, all 6 of the available currency pairs at the PhilX, but for our class, I thought it was a good idea to put them all on to kind of get a feel for how they move. So here are the deltas and the gamma, but my problem is my hedges are down here. If you'll notice, you have to get used to getting rid of the zeros. But the Aussie US, if you look on which one, I'm trying to give one side. Oh, here's an example. The yen is showing me I'm short 1,400 deltas in yen, but I'm also short I'm short 1,200 of the dollar yen FX spot. That's an example where I had to sell the FX spot to in effect get long the yen because I sold the dollar and was a buyer of the yen. So you could just sit here and in your mind try to do the delta back and forth and write it out by hand. I don't know how many of you would like to do that. Yeah, this is what we're doing. In fact, I mean, we've got the trades in here from the practical applications class. We still have some of the trades on from our platinum class down. I somehow got to be the guy that was able to was designated the keep track of this stuff guy. And in fact, there's that waste management trade, which was just a great trade. Did that. What did we do? We did the buy right in there. That was a great trade. Anyway, I digress. So I looked at this and was saying, this is great information, but I don't have anywhere to be able to check this, and I don't have the ability to give me a number, because when you're delta trading your gamma, you really want to make sure you pick a strategy and hedge accurately. So here's what I'm going to show you. We are going to show FX here. This is what my spreadsheet will do for you. Up here you'll see the opening positions all done today. Again, there's no magic here. I bought the straddle, bought 100. Here's my symbol. I bought October. Here was my strike price, and here's what I paid for those options. Simply, this is for while you're sitting at your desk, or if you want to print this out, and if I print it out and keep it with me. So, okay, now I know what I've got on, but what's my current position? These fields in red. Elizabeth, we're losing you with the math. Well, I'm going to have to go through it anyway. This is going to simplify the math for you. What we got to do is I'm going to open up on my other screen so I can fill these in. The current, move this off. Current spot for the Australian dollar is, okay, for trading. Well, yeah, I'm going to leave this here for right now. Let me update it. So if you wanted, let's say you had these positions on. Right now, I'm showing at the end of the day, based on the closing prices, here's my delta that I've input from Thinkorswim. The red areas are the areas that I have to input something. The others calculate themselves. And here you can see I put 14 down, which means I'm short 14 of the minis, which comes up as 140,000. So you do have to get used to the math and the numbers. Based on the closing prices and where the spot was at the close, I'm long 161 deltas in the Australian dollar, long 172 deltas in the pound, long 585 deltas in the Canadian, long 34 in the Canadian, short 34 in the yen, and I'm short 100 in the Swiss. I put this little yellow in as a warning. These are the ones that you have to hedge, what we would call backwards. And what I did was I even came up with a gamma calculator. I did an upside and a downside. Again, you have to input what your current gamma is, but it will take the spot price from up here, and it will figure out for you if you want to trade 5 contracts at a time. It will tell you what spot price would you need to put your next sale if it moved to the upside. So in this example, again, just an example, the current spot is 0.8737. And I'm saying, well, when I get long 5 contracts, what we would all kind of refer to as 500 delta, I want to then sell. Well, where do I have to put a spot offer at to sell that? Well, I'd have to put the offer out at 0.8753 to sell 5. And the next one would be, well, where would I have to put my next offer out if I wanted to sell either up 10 contracts total, or if I wanted to sell 5 more? You'd have to know that if you did 5 at this side, you'd only be doing 5 here. The next number's 0.8775. You might say, hey, Greg, you know what? I don't really care. I want this thing to be, I want to go big, 1,500. Well, then the spot price changes. And I want this to be, 20 after that. Where's that go? Well, there's where it goes. So it's a dynamic spreadsheet that allows you to calculate your gamma, the impact of your gamma on your delta at any time. Normally, you find this built into Thinkorswim because you can bring down one of the pull-down menus onto your position, and it will take your hedge, normally your underlying stock, and your option delta, and it will give you a net delta. We don't have that luxury, so we had to have a tool. So this is the tool that I use, and it's, let's see. And then what I also did the exact same thing for the downside. If I wanted to put where would I buy, this figures out 5 contracts down, 10 contracts down, what are my prices. So I'm just going to make a quick change. I'm going to change the index prices. The delta hasn't changed. My current hedge hasn't changed. And I'm going to show you what it does to my delta. Currently, the Aussie-US, of course, it's Aussie-US is 87.25. Hope this works, or I'm going to feel like a dope. Because I'm still working out the kinks in the formula. The XDB would be 186. They haven't really changed. The market hasn't really moved. 186.51 doesn't really change. The euro, it's 147.76, and the Canadian is reversed, 1.0590. Inverse is 94.43. 91. What's our yen is 109.67. The inverse is F6 is 191. Geez, it's almost exactly. It's 91.18. And the Swiss is 1.0964 versus 91.20. That's actually up a little bit. 91.20. This should have calculated, checking my F16 times 100. Hasn't changed. Yeah. So that's our updated prices. So again, it's a tool that I use that allows me to, during the day, actively calculate what my delta is. But what you can use it for, we go back here as we wrap up. What you could use it for is at night, if you wanted to trade, or if it's right now daytime for you, if you wanted to trade, you could have an options position that you are able to have some sort of built-in protection. You've got a safety net of the risk power of options, which is a horrible way to phrase it. The risk limiting ability of options, but you can also be trading the FX. So it's one of the first strategies we're going to talk about, but that whole idea of trading gamma would allow you to move back and forth with the underlying spot market by having a gamma position. Could you just put a call? Could you buy calls and that be your gamma and trade against it? Sure, you could. I put on a straddle just for example purposes only for our class. Well, here we go. We've gotten to 11:24. It's a little too late. I'm sorry for running late tonight, guys. Here, the final look tonight at our Thinkorswim case sensitive at the end, the TOS, and we are going to roll out on that. I want to thank everybody. We are going to be back here on Monday night, Trading Gamma, talking about longer-term trades, and we're getting ready for Sunil on Tuesday night with his FX technical analysis class. I appreciate everybody taking the time to be with us all 3 nights this week. 3 down, 6 to go. We're really starting to get, as I said earlier, into the meat of this. Now that we've laid all the groundwork, I think everybody's ready to find out why it's such a great idea to use FX options, the number of different strategies you can use to implement them into the way that you trade now or the way that you like to trade. I'm going to stay here, and I think I'm trying to remember who it was. It might have been Dave who wanted to know about the MOBO bands. Thank you, Dave. I was just going to say that I'm going to flip over right now. I'm going to bring up Thinkorswim, and as always, thank you, Blaine. You can shut her down if you like. I don't think any of this, the rest of this, is going to be overly. Now you might want. I'll keep recording if you want to keep it on. I'm going to try to show everybody how to get those MOBO bands up. I could just find my Thinkorswim along the bottom here. There it is. Slide this over. Pull it out. There we go. Okay. So here's what we've got. Anybody, before we get to this, just so you know, I'm going to stay. I'm not going anywhere. If you can follow along with me on the loading up the MOBO bands into your Thinkorswim charting package. If you have any other questions, please put them in now. We'll be here for a little bit. But again, I appreciate everybody's time tonight. Thank you very much. Good night to those of you where it's dark, and yes, good day to those of you down under on the other side of the world. So here we go, David. This one's for you. You're going to go to charts. You're going to go to, as my friend Cindy likes to say, the little wrench. Did I switch or not, guys? Did I switch over there? I'm sorry, my computer screen. I apologize. Thanks, Elizabeth, for keeping me on the straight and narrow. There we go. So here's our Thinkorswim chart. We can play with the profit and see if we can find you guys some possible educational trading opportunities for your paper trading account using the profit's predictive sort of trading software, chart recognition software. So again, everybody who's with me probably want to make 2 little screens so you can look at your Thinkorswim and follow where I am. I will kind of talk you through it also. If everybody's ready to go, David, if Dave's ready, then I'm going to figure everybody's ready. Dave, you ready to go with the MOBO bands? Great. I'm going to go to the little wrench here. I'm going to click on the wrench. No, you're not. It's not the wrench. My bad. There it is. You're going to click on this one, the little eyedropper thing next to it, and you're going to scroll down to, or you can type up here, Bollinger Bands. You want to click on Bollinger Bands. That should open it up for you, and you'll see the study properties. What you want to do is you want to change your properties so that the displace is 0, the length is 10, the number deviation down is minus 0.8. It's 0.8 standard deviation. And the number deviation up is 0.8. Your price is going to be the closing price. You can make, and then below, you can make the midpoint, the lower and the upper bands any color that you like. And then if you choose, you can save this by clicking in the bottom left here. You can save this as your default, clicking in there, and hit apply and hit OK. And what that will do is that will change the parameters. You now have you now have the MOBO bands. Everybody got that? Are you with me, Dave? Might only be Dave doing this. So what you're in effect doing is changing the MOBO band, the Bollinger bands that you currently have, to reflect the calculation that David has come up with for his MOBO. So when you do that, you would hit, I'm going to hit cancel because I already have. What you would do is, I would go over here to studies, study, all studies, then you're going to go to the B's and find Bollinger bands that you just modified. Dropper is you have to go to charts, Paul, and it's the eyedropper thingamajigger, the wrench, then it's the days, then it's the charting, then it's the styles. You can also go to, call it. Can you go to studies? No. On the right, top right, Paul, it's the left hand, it's the far left icon of that section of icons on the right. If you want, maybe I can do a. Now we know that we've changed the MOBO bands. You go to studies. We're going to add a study. Go to all studies. We're looking for Bollinger bands, so it should be between A and C if my Catholic education holds up. Take this, we go down to Bollinger bands. Drop the Bollinger bands that we've modified and made MOBO bands into your chart. I see some people typing, that's why I'm pausing, guys. Well, here, Dave, you'd have to change the name of the study, and that's possible. Let me show you. Same thing, bring up Bollinger bands. It goes this way. Oh, you know what? Here, you know what I missed? Here's what we need to do. Here's how you do that, Dave. Let's look at, if you double-click on, give me 1 second. Do we double-click here, or is it double-click here? I got to think about. You know what? You do have to go in and change the coding. It's pretty simple. Let's just go through this, and if you change the Bollinger bands, the objective here. One more thing: if anybody's having trouble with MOBO bands, putting them on there, let me know. Send me an email, and we'll get you the details. The last thing I want to show you is when you use David Elliott's studies, the other two things he adds are the 50-day moving average and 200-day moving average. So you can put those on this add study. I'm going to go to moving averages. Create one just yet. Down to the bottom here to simple moving averages. Again, quick study, all studies, quick to moving averages, simple moving average. And when you open that moving average, it drops in a 50 because that's what I've set as my default. You can also edit simple moving average by right-clicking on it, open it up, and you again just change it to 200 days. When you get it set, it is available. That would be news to me, Laura, but that wouldn't surprise me. They don't. Let me look under AB's way. But here's what I'm going to show you. The last thing, and this is one question that comes up. Somebody gets their chart style set. They like to look at these particular things together. How do they save it? That I didn't want that. To save what you've put on your screen, and you say, hey, look, I want my charts to be candlesticks with a 50-day moving average, and that's it. What you would do is you go to study, save a study set, and just give it a name. And it will, when you then go back and say load a study set, you can see I have a number of them here. Here's my MOBO study set. And what do you get? That looks like a bunch of junk, but you get a 50-day moving average, 200-day moving average, MOBO bands, and an RSI. That's kind of my basic, normal pattern. And I'll agree with anyone who's thinking it, yes, that 200-day moving average is a little obnoxious, and I may need to edit that down because it's starting to even bother me. It's getting a little bit too wide. Seems a little better. Yeah, a little bit easier to look at. So just a quick look at Thinkorswim. I'll talk to Ron about maybe we can set up a Thinkorswim night. Maybe we can even get Cindy, who was our Thinkorswim expert who came in for the Platinum show down in Fort Lauderdale, to maybe spend some time with the Mobo bands. Considering that we're using David Elliott for our OUS service, maybe people would probably like to be able to see what he's seeing. So it's a big one, Dave. Anybody have any questions? I'm going to flip back to my main screen. I'm going to let everybody go. It's getting late. Hanging in tonight. We're really starting again, like I said, get into the meat of this thing, and I'm excited about getting you guys up and running, getting paper trades up, and starting to feel really comfortable and confident that you can trade in this really volatile and the world's largest trading. Do me a favor, send me an email, and I'll see if I can find. I'll reach out to Cindy, who's our Thinkorswim expert. She works for Thinkorswim. Or I'll just sit down and stare at the machine until it comes back to me. I'm missing one piece, and when I think of it, I'll lay it out in screenshots for everybody and put it into a Word doc so that you can see how to do those sort of changes. Put it on my to-do list, so I'll get that done for you. Have a great evening, and I look forward to talking to everybody 9 p.m. Monday. Enjoy.